crypto market is rallying. Coins and tokens are hitting all-time highs. Your friends and family are asking you about crypto.
Learn it's all cryptocurrency now, you dino.
And I now take cryptocurrency.
And everyone is watching videos like this. It must mean the top is in, right? Not even close. And that's because the big money is just getting started. According to a recent report, almost 60% of institutional investors plan on allocating more to crypto. And that could mean billions of new inflows in 2025. Today, we're going to summarize this report, reveal which cryptos institutional investors are about to grab with both hands, and tell you exactly what this could mean for the crypto market. Don't go anywhere. The report we'll be summarizing today is titled, quote, Future Finance Report 2024. It's a survey of institutional investors that was recently conducted by Syngum, a Swiss banking group which is focused on crypto. We'll leave a link to the full report in the description if you're interested. Now, the report begins with a short message from Syngum co-founder and CEO Matthias Imbach. In it, he reveals that increasing regulatory clarity in the US has institutional investors spending more time analyzing promising crypto projects. In other words, they're starting to pay closer attention to altcoins. Matthias also reveals the categories of altcoins institutional investors are interested in: DeFi, RWAs, and account abstraction. Of all three, DeFi is arguably the most undervalued, and that's just because it's been the most affected by regulatory uncertainty. And now that regulatory clarity is increasing, DeFi will fly. And by the way, if you're enjoying this video so far, then be sure to karate chop that like button, punch that subscribe, and flick that notification bell to make sure you don't miss the next one. Anyways, after that short message from Matthias, the report's authors briefly explain their methodology. They reveal that they surveyed over 400 institutional investors from 27 countries. Respondents included banks, hedge funds, family offices, and asset managers, basically as institutional as money can get. Next, Syngum's head of research, Lucas Schweger, provides a message of his own. He reveals another category of altcoins that institutional investors are interested in, and that's deepen. In fact, Lucas specifies that institutional investors are interested in crypto projects that interact with existing systems. So take note. After this short message from Lucas, the authors give more details about the institutions that responded in the survey. As you can see, they mostly come from Europe and East Asia, which is not surprising given Syngum's location. What is surprising, though, is that the Middle East and Oceania were also represented in the survey. It's also important to point out that 61% of respondents were high net worth individuals, not institutions per se. It's also worth pointing out that 76% of respondents had high or very high knowledge of crypto and blockchain. And this means that most of the survey respondents are essentially crypto natives. Even so, that doesn't change the fact that most of these investors have been actively investing large sums of capital in crypto and have plans to continue doing so. Naturally, the biggest investors have been family offices, hedge funds, and asset managers, with banks and the like being a bit more hesitant about allocating. And this is where things get interesting. 83% of respondents said they're currently investing in crypto. And recall that only 76% of respondents said they had a high or very high knowledge of crypto. This suggests that 6% of institutional investors are aping into crypto without fully understanding it, which is kind of crazy. But of course, this depends on what you mean by aping in. Professional money managers don't go all in like we do. Allocations of a few percent to Bitcoin are already considered to be a bold move by many. And that's why the authors effectively define aping in as holding more than 10% of their portfolio in crypto. Lo and behold, 53% of respondents hold more than 10% of their portfolios in crypto, which makes them degens by institutional standards at least. What's wild is that 13% of respondents noted holding more than 50% of their portfolios in crypto. The authors note that most of these degens are high net worth individuals. This is significant as it suggests that crypto is a way of achieving a high net worth. The caveat is that the sample is biased. Remember that 76% of respondents are essentially crypto natives. Obviously then, chances are that most of the respondents made their money in crypto. The devil really is in the detail, folks. That being said, there's no denying that incredible wealth can be made in crypto, even if you're relatively new, which begs the question of how these institutional investors are actively allocating their capital. Thankfully, the report has the answer. First, the authors note that 63% of respondents have a high risk appetite. Higher risk, higher reward. Go figure. Now for the fascinating part, the actual cryptos these investors are buying. As you can hopefully see, 90% of respondents are investing in, quote, blockchain protocol tokens, which can be simply understood as layer 1 coins. BTC for Bitcoin, ETH for Ethereum, the coins that power actual blockchains. The authors highlight the fact that institutional investors are primarily allocated to, quote, well-established layer 1s, specifically BTC and ETH. However, they note that these institutional investors have been gradually increasing their allocations to other established layer 1s like Solana and BNB. The remaining allocations are where things get even more interesting. 50% of institutional investors reported holding stablecoins. 40% had tokens belonging to dApps. 39% held NFTs. 11% held privately issued tokens. And 6% held tokenized assets. Seems tokenized RWAs aren't that big after all. In any case, unfortunately, the authors don't specify exactly which stablecoins, dApp tokens, or NFTs the institutional investors hold. Fortunately, we can assume that the dApp tokens fall into the categories revealed earlier. Now, to refresh your memory, that's DeFi, RWAs, account abstraction, and deepen. As for the stablecoins, we can assume that most institutional investors are probably using them to earn a yield by doing things like lending in DeFi. The NFTs, though, are where things get truly tricky, which is annoying because it would be good to know which collections institutions find interesting given their allocations to this asset class. It's actually insane that institutional investors hold regular tokens and NFTs in equal proportions. This suggests that we retail investors should watch NFTs more closely, because chances are they're going to be a big narrative again. The fact that nobody's paying attention to NFTs makes them an asymmetric bet, even more so than DeFi, which, I'll remind you, has also been kind of off the radar.
We regret to announce that the Bro Crypto podcast is sponsored by the Coin Bureau Deals page. This is the place where you can find the very best deals and promos in the crypto space. From massive trading fee discounts to insane sign-up bonuses on some of the best crypto exchanges. You'll also find crazy discounts on hardware wallets, and you can sign up for our exclusive Coin Bureau Club there too. So, check out the Coin Bureau Deals page today. Otherwise, you'll have to keep listening to these two idiots.
Hell, that's the problem a lot of crypto bros have these days. They're inside too much, 24/7 on the
computer. Open your inside, you get out, you get some sun, you get some vitamin D. Regardless, the report goes on to answer 4 pressing questions. Why are institutional investors allocating to crypto? What are their future plans for allocation? Why are they looking to increase their allocation? And most importantly of all, when are they planning on increasing their crypto allocations? Let's start with the why. 62% of respondents said they're allocating to crypto to get, quote, exposure to the crypto mega trend. The authors explain that this means they're allocating because they believe that crypto's adoption and price will go up and to the right indefinitely, underscoring a long-term view. 52% of respondents are allocating to crypto to diversify. 45% are using it as a hedge against macro conditions like money printing. 38% are using it for yield, and 36% are trading it short term. It goes without saying that there's a bit of overlap with these responses, and it's safe to say that the point about institutional investors using stablecoins to earn yield is likely accurate per the responses to that question. And this ties into the when. For starters, 57% of institutional investors want to increase their allocations to crypto, but you already know that if you've been paying attention. And yes, the main reason why institutional investors want to increase their crypto allocation is to increase their returns. Regarding timeline, a staggering 79% of institutional investors plan on increasing their crypto allocations over the next year. Notably, this figure includes institutional investors that are looking to allocate for the first time. Even more notably, most institutional investors who aren't allocated will be in the next year. Newsflash, but this suggests that billions of dollars are likely to pour into not just BTC, ETH, Sol, and BNB, but DeFi, RWAs, account abstraction cryptos, DePIN, and, apparently, NFTs. And this is further confirmation of the fact that 2025 is going to be extremely bullish for crypto, including altcoins. This is where things get interesting again. To their credit, the authors asked institutional investors who aren't allocated or aren't increasing their allocations why they're hesitant. The answers are what you'd expect. 53% said volatility, 50% said a lack of trust, 44% said security and custody concerns, 42% said a lack of regulatory clarity, and 24% said a lack of regulated crypto entities. The authors find a silver lining in the fact that a lack of regulatory clarity is no longer the number one reason it had been in previous surveys. The catch is that volatility and trust taking the top spot could have to do with events around the time the survey was taken, something the authors do acknowledge. But if volatility truly is the number one concern for institutional investors, that's a problem, because that's something that probably won't be addressed anytime soon. In fact, it's a bit of a paradox, because crypto will become less volatile as it matures, but that requires more investment from institutions. The silver lining in this context is that improved regulations will make it easier for institutional investors to invest, but this won't happen until the infrastructure is there: crypto custody and regulated crypto entities. And this need presents a huge opportunity for those looking to start a new crypto project or crypto company. Not life advice. Now, in the next part of the report, the authors unpack the crypto investment strategies and crypto products and services that institutional investors use. In terms of strategy, 44% of institutional investors allocate to individual tokens and actively and passively manage their positions at a similar rate. When it comes to products and services, 67% of institutional investors are interested in trading products. 48% are interested in asset management products. 43% are interested in custody products, and 40% are interested in staking products. And this relates to what I said a few moments ago about new crypto ventures. Whatever the case, this is where things get fascinating again. The authors found that only 23% of institutional investors are interested in futures and options. To put things into perspective, 72% of institutional investors are interested in trading, suggesting they might not be degens after all. In all seriousness, this just goes to show that smart money isn't gambling on AI meme coins with 100x leverage. They're trading on the spot market, and almost half of them seem to buy and hold rather than actively trade. If this strategy is working for them, it might work for us retail investors too. Not financial advice. But wait, there's more. The authors found that 72% of institutional investors are interested in direct crypto exposure, compared to 47% who are interested in ETFs and ETPs. Again, this could be a consequence of the cohort the report surveyed, but it nonetheless suggests that most investors prefer to own crypto directly. This once again pertains to the opportunities available to those willing and able to create solutions to that end. But I think I've made my point. You'll make more money working in crypto than investing in it. But if you'd rather invest, I've got good news for you. The authors provide some more details about the categories institutional investors are interested in. Although layer 1s are the most popular by a wide margin, institutional investors are also interested in Web3 infrastructure, such as account abstraction, Layer 2s, DeFi, Layer 0 chains, stablecoins, RWAs, metaverse cryptos, Web3 consumer dApps, and GameFi. Better yet, the authors finally drop a few names. Besides BTC, ETH, Sol, and BNB, respondents noted being interested in Tron's TRX and Toncoin's Ton. This is peculiar, but likely reflects the composition of the respondents. In case you forgot, many are based in Asia, where Tron and Toncoin are popular. Funnily enough, the authors seem to FUD Ethereum a little bit, as they note that its Layer 2 space is becoming diluted. That's an understatement. There are over 50 Layer 2s and counting, according to L2Beat. What's not so funny is that the authors note institutions aren't very bullish on GameFi due to its limited adoption. And the same is true for the metaverse, but in that case, it's understandable. The real world is just so much cooler. Oddly enough, the authors dedicate some extra space to discussing tokenized RWAs, despite institutional investors only having about 6% allocation to RWAs per their own findings. And this might have something to do with the fact that most RWAs are tokenized treasuries, which are becoming less appealing as yields continue to fall. The authors asked institutional investors which assets they'd like to see tokenized, and their top answers were the most obvious: stocks, bonds, and mutual funds. Put differently, institutional investors want to be able to trade other popular assets in the same way that they can trade crypto, 24/7 with lots of liquidity. If you thought the answer was going to be real estate, the authors do note that institutional investors did want to see tokenized real estate before, but interest in tokenized real estate has kind of fallen off a cliff since then. They note that this is because tokenizing things like real estate is just too complicated right now. Now, in the final part of the report, the authors take a closer look at the actual opinions that institutional investors hold about crypto. And this involved asking them a series of questions about specific crypto catalysts, like the approval of spot Bitcoin ETFs in the US and how these are affecting their allocations. To be honest, most of these responses are no longer relevant, as the landslide victory by Republicans has practically guaranteed that good crypto regulations will be passed in the US next year. Heck, the new US president is literally launching his own DeFi protocol. That's going to require good crypto regulations. Crypto regulations aren't just improving in the US either. They've also been improving in places like Hong Kong and Dubai, which are becoming the de facto capitals of crypto. This is indeed something confirmed by the respondents, who note that crypto regulations have improved significantly everywhere since 2023. Be that as it may, the authors found that institutional investors are still cautious in the short term. And this is due to a combination of crypto-specific factors, like BTC sales by large entities like the German government in GMI, as well as macro factors such as a highly uncertain geopolitical environment. As expected, the authors found that institutional investors are feeling a lot more bullish about crypto in 2025, which is precisely when they plan on increasing their allocations. As the saying goes, though, bull markets climb a wall of worry, and I think we can all agree that there's been a big wall of worry lately. On the flip side, the fact that institutional investors are bullish on crypto in 2025 to the point that they'll be increasing their allocations suggests that the crypto market could start crashing sometime later next year. As it so happens, another survey found that crypto investors expect the market to top in the second half of next year. I guess that means that crypto will top in the first half of 2025. Hey, I don't make the rules. And this brings me to the big question, and that's what the findings of this survey mean for the crypto market. I revealed the answer earlier. It suggests that billions of dollars could flow into the crypto market, mostly into Layer 1s, DeFi, RWAs, NFTs, account abstraction, and a bit into other niches. In case it wasn't clear enough, all of these flows will come sometime in 2025 and will likely result in new all-time highs for most of the cryptos in these categories. While the institutional investors that Syngum surveyed aren't particularly bullish on cryptos in other niches, it doesn't mean that they won't pump, including meme coins. On the contrary, every crypto will pump, even those that are known to be literal scams. The only questions are how much they will pump, when they will pump, and what the risks are. That last component is something that institutional investors are hyper-focused on. They love established cryptos. As such, it's likely when cryptos in other narratives like GameFi start pumping, institutional investors are going to flock mostly to the established blue chips. And this is hard for us retail investors to wrap our heads around because we have a habit of chasing every shiny new crypto that appears in each niche. Not only that, but lots of retail investors believe that allocating cryptos that have been around since the previous cycle is a bad strategy because they have lots of bag holders. Well, Syngum's institutional survey suggests the opposite. Cryptos with the longest track records are the most loved by investors. And this makes perfect sense when you think about it. Even though cryptos from previous cycles have bag holders, the only ones still holding after the bear market are true believers in the project. By contrast, new cryptos have insiders who are itching to sell, partially because they want to realize a profit, and partially because they themselves probably don't know if crypto will actually survive long term. So if you're holding older cryptos like ETH and are looking at your portfolio wondering if you should ape into the latest Solana killer like everyone else, rest assured that the cavalry is coming. And given how beaten down ETH and its peers have been, they could see the biggest gains in 2025 as a result. Take note. And that's all for today's video. If you found it informative, be sure to smash that like button to let us know. And if you want to stay informed, well, subscribe to the channel and ping the notification bell as well. And if you want to inform others about which cryptos institutional investors are buying, then share this video with them. As always, thank you very much for watching, and I'll see you in the next one. This is Nick, signing off.